Hey guys, I recently delivered a learning session to CPA Australia in front of 50 accountants online, and we went through questions like my trigger point to make property full time, how to buy property interstate, where to buy, how to buy, my best tips in the current 2023 property market, and just teaching all of these wonderful accountants how to zoom out and think about leaving their 9 to 5, or at least being able to set up their financial future so they can retire early. We went through the mechanics of property investing and a whole bunch of inspiration of why they should do so too. So much we covered in more than an hour long session with CPA Australia, amazing accounting organization. I was grateful to be hosted by Yuki Huang. Check it out, there's so much gold in there. And let me know what you think. Here we go.
The other question is coming up is when you're hitting that trigger point, you say, okay, that's full-time job is just not what I really enjoy it. I want to run my own show or running your own business. I'm pretty sure some of our members also have this concern saying, look, and currently like the economic market is not strong enough.
Mm.
We think about maybe I should take a second job or if doing something I'm really interested in it. So what's the trigger point for you and decided, okay, that's it. I want to quit this 9 to 5 jobs.
Yeah.
Yeah.
It's a good question. I think there was like two trigger points, and at the time, I don't know if I thought of them as trigger points, but in hindsight, they probably were. I think the first one is that around 2015, 16, I'd already had a few properties, and I realized that my pay increases from like just increasing the rents every year according to whatever the market rent was. Like at that time, I was getting more of a pay increase through the real estate investments every year than my actual job. So I was like, hang on a second, like I'm not even spending any time on real estate. But that's giving me more of a pay increase every year than like a 3% pay increase, or you have to fight. I remember like, as kind of employees, we would just think, oh, okay, if I get a 5 out of 5 star rating this year, then maybe my boss will give me a 4% pay rise, or I might scrape through like a 2% pay rise. And so like we would make such a big deal out of it. And no disrespect to anyone who's kind of going through that. But then here my properties were like getting a much bigger pay rise, and there was no politics involved, and there was no like any effort whatsoever. So I was like, hang on a second, like that doesn't quite sound right. There's something in this that I should invest more heavily in terms of my energy, my time, and my focus. So it was really at that point where I started to think, if my real estate investments can give me a passive income enough to like live off, then I can leave my 9 to 5 and really invest more and more into real estate, and do more and more with real estate to scale that up. So that was like the first trigger point. And I think the second trigger point was, even though I was in a, I would say, semi influential and perhaps high ranking role at Virgin, I was finding that I wasn't able to actually make that much of a difference. So I'm sure a lot of accountants can relate to that. And of course, no disrespect to any companies or firms that you work in or work for. But in big corporate Australia, you're just a small statistics. And no matter, I don't know, this is highly controversial, no matter how much they kind of value employees, they value the human resources, they value their people. At the end of the day, like I think you're just another person, you're just another statistic. And at least that's how I thought about it. And I was reporting directly to the CEO, so it was a fairly high profile role. But I was finding that all the PowerPoint decks that I was creating and presenting to the CEO, the C-suite, the board, all the meetings that I was in with all the executive GMs, etc. Like there was just so much politics to get anything done. I think my biggest achievement to some extent that is tangible was, I don't know if anyone flies Virgin, but we released Economy X, which is like the front row of the economy cabin. It's almost like a premium economy part of domestic flights in Virgin Australia, and that was like a $40 million revenue upside initiative that I came up with, and it cost about $5 million to implement capex wise. And on an ongoing basis, it was like wildly profitable, like almost $40 million in net marginal profit. And all I really got for that was like a pat on the back and like a 3.5% pay rise. So I was like, hang on a second, like it took me so much blood, sweat, and tears to convince you guys to do this. It's made the company so much profit, which is actually a huge thing because you're a loss-making entity. And yet I'm not feeling valued. I'm not feeling like what I've done is like changed too much, anything at all, except for just shareholder value. And so I felt that I needed to do something that actually had more of a human impact, like not just B2B, but B2C, like change people's lives in the humble way that I could. And that's when I started kind of mentoring people in property just on the side while working, mostly just for free, actually. And that kind of was giving me more satisfaction and reward than my, you could say, highly paid 9 to 5.
That's nice. Yeah, I totally understand because I work in the banking industry, so I can see this how much I've hard work from all those bankers to looking for deals, customers, and to the end they just get like the bonus. Sometimes they mark down for a lot of reasons, which I don't see what's the point there. But we not encourage you guys to quit your job,
No.
that for sure. Yeah, just sharing some what we thought, and then yeah, totally agree with you. So the other question is, we probably people want to more find out is what you doing as a property investment coach. Like, what's your daily job looks like?
Yeah, sure. I think like what a property investment coach or any coach in any field really does is like they teach people how to fish. And so what I don't do is say, oh, Yuki, like I've got this amazing property deal that's going to make you $1 million. It will allow you to retire in a year's time, sign on the dotted line. Like that's not what I do. What I do is teach you, just like, all of the people on the call, by and large, you guys are accountants. You've done the CPA qualification. You've learned how to become an accountant, and you're proficient at accounting, like millions of miles ahead of me. And I wouldn't even try to do accounting compared to what everyone here can do. So similarly, in wealth generation for yourself, as opposed to others, or as opposed to counting money, I'm interested in making money for myself, and that's what people are interested in too. And so that's what I teach them how to do through real estate. In Australia, it's a very unique market where, unlike the US and maybe some other geographies, real estate can be done completely passively. And this was like the epiphany, you could say, that I stumbled upon, that you can actually continue to do your day job. Like Yuki was saying, you don't have to quit your job. You can do this on the side and slowly transform your active income. Like if you run a business or you get a PIYG income, transform that active income into passive income. Because I know that when you're well paid, that's great, and you think that everything will be fantastic. But the number of times I've seen like the executive assistant of a partner, let's say at PwC or Deloitte, the partner's earning 300 to 500K plus bonus, living a really good lifestyle, great for that person, good on them. The EA, or the personal assistant, is maybe making 80 to 120, maybe 100 to 150K, depending on their stature in the company. And so they're not making $500,000, but that EA or PA has more net wealth than the partner. And the reason is they're investing it wisely, whereas the partner might just be keeping it in the bank or giving it to their financial advisor. No offense to any financial advisors out there, and just investing it in the stock market, which is highly volatile, goes up and down, dividends come and go. In the PA is investing it into real estate assets, which are going up, providing rent, etc., etc. And then 10, 20, 30 years later, when both of those, the EA stops working and the partner stops working, the partners earn so much more during their life, but they've never actually transferred that active income to passive income. So when they stop working, they realize, hang on, I can't afford the lifestyle that I was living for the last 30 years. Whereas the PA is like, actually, I can afford the lifestyle that I was living and then some, because I took care of my nest egg. Okay, I didn't just keep it in the bank. I didn't just outsource it to others to manage. I actually learned financial literacy. And I think that was my biggest thing that I learned, and I'm trying to impart on others as a coach, as you said. Financial literacy. If you actually, no one teaches you, not at school, not at university. You can do like a finance degree like I did, but from a really good university, but they never actually taught me how to make money. They only taught me how to make others' money, my employer money. They never actually taught me how to make money myself. And I think if you can, teach a man or teach a woman how to fish, then they can fish for a lifetime. So that's really my aim, to teach people how to develop a property strategy, teach them how to select the right suburbs, teach them how to select the right properties, how to value them, how to negotiate, and how to scale using finance techniques, tax techniques, etc., etc.
That sounds very achievable. So, um, the other question I probably ask is, I think is that you're, sh like sharing your knowledge and some like your thought, and also really also plus a lot of data sharing through the Facebook, your blogs or YouTube. What did you find the most challenging part for those young investors or new to the market? What are the challenges they're facing currently?
Sure, sure. I think like the biggest challenge or the biggest thing that causes fear in the hearts of people who go down the property investing route is just the amount of misinformation or conflicting information or hidden agendas or hidden biases or innuendos that exist in the Australian property marketplace. So, for example, when I was getting into it initially back in 2011, I tried to learn about property investing by going to different seminars. And you go to a seminar, I don't know if anyone here has been to a property seminar, but there's normally someone on stage and they're wearing like a nice suit, unlike me right now. And they're talking like the big game. They have a cool PowerPoint slide and they'll be like, this property will go up by this much and this will change your life. And they'll show you a picture of you now and then a picture of you driving a Mercedes GLE in like 5 years' time or whatever it is. And honestly, it's just there's so many sharks, there's so many charlatans, there's so much poor form that exists in the real estate market. And normally, they try to force you a property. Like I remember, at least for myself, there would be a seminar that I'd go to and it all sounded great. But at the end of the seminar, they'd say, go to the back of the room. We have a special discount right now if you buy this property or put down a deposit or do X, Y, Z. And so that really put me off. And I think that really puts a lot of people off because there's 25, 26 million people who live in Australia, excluding the children. Everyone is a property expert. You have a barbecue or you have a gathering at home or you go to even over the water cooler with your colleagues at work. Everyone's like, whether in Sydney or Melbourne, wherever, everyone has like an opinion. Oh, yeah, this suburb's doing well. That suburb's not going to do well. I made this much money. I lost this much money. Everyone's an expert in real estate. But I tried to cut through that by looking at true data. And that was really something that no one had done back then. So because I had a background in investment banking and I studied econometrics at university, I was able to get the raw data for 30 years of Australian history, real estate history, and actually run statistical models like multivariate regression analysis to actually see what truly correlates with capital growth. And I know we're getting a bit technical here, but I quickly found that it's actually not the things that people think it is. It's actually not proximity to CBD. It's actually not, like the properties that grow the most are where the people make the most incomes. It's not that Sydney and Melbourne grow far more than other areas around Australia. So I was like, okay, now I'm actually starting to understand what truly drives property markets. And I was able to build like a data system. So I know everyone here is probably very into data because you're accountants. So I was the same. Like I wasn't an accountant, but an investment banker basically lives and dies by data on a daily basis. So I think that's the biggest challenge that people have. They go into property investing because a friend told them to invest here, or a colleague told them to invest here, or an expert where you saw a Facebook ad or a YouTube ad or this and that, invest here or do that or do this. And then they really struggle. Their statistics are that more than 70% of investors don't get past the first property. And so naturally they think property investing doesn't work. I need to double down in my 9 to 5 in my business, make wealth that way. But if you can actually use data and do things in a more just objective way, stripping out the opinions, stripping out the subjectivity, then you can get to 2, 3, 4, 5, 6, 7 properties and use that as a vehicle for retirement. I think, yeah, that's sort of the best way to overcome that challenge that new investors face of just information overload and people just trying to like take your money, basically.
I agree because I actually my job is helping like business owner or like individual to getting the lending done. So more like a mortgage size or business lending. What I found is some of my clients, they like, for example, they doctors, they're very busy for their daily job. But when actually going to that investment part, they feel like really lost. So to the end, they actually found a buyer agents.
Mm-hmm.
So just recently, one of my clients, she's a doctor and she based in Queensland as well. So she found a buyer agent. The whole transaction, she just no idea what they like looking for the property for her. And the end, I think they found the property at WA. And luckily enough, that property, I think it's just in the regional area somewhere, down like small town. I have no idea how they got that property for her, but um, the transaction went through, and to the end, even the vendor changed the settlement. She has no idea until the bank let me know. Say, oh look, there's a settlement change, so it's really lost. And then she said, oh, I won't be recommend those by agents in the
Right,
market, which I
right.
understand. So, but because she's quite busy, she doesn't have a time. Like let me say, there was a what we can see during the COVID period. There's a lot of like movement buying the investment properties from Interstate. So for those investors or the people who are interested to purchase property in Interstate, what's the advice or suggestion you will be giving to them, like as the starting point? Because obviously we cannot like travel to the Interstate to look at the properties every weekend, right?
Yeah.
Yeah.
No, that's a great point. And I'll just add to that point as well, that you made. I really feel that, like I said before, no one cares about your money as much as you do yourself. And so, like accountants will tell you, and with all love and respect, I'm saying this, a lot of accountants suggest people buy negatively geared properties, which means that on a yearly basis, the expenses are more than the rental income of the property. And they suggest this because it obviously saves tax. You make a rental loss and you can offset your income. And a lot of, I would say, novice property investors think this is a fantastic idea. Like, who doesn't want to save tax legally, of course? But if you just step back and think about it, why would you buy an asset that you're going to lose $1 on only to get half of that back, get 50 cents back on tax? Like, you're still down 50 cents, right? It's still negatively geared. So, in that case, a lot of accountants maybe, I would say, innocently lead their clients astray. And same with buyer's agents. I think there are some good buyer's agents out there. But if you're just allowing someone else to make a $500,000, $1 million decision for you, then you kind of have to ask yourself, like, are you financially literate enough to manage them? Because you have to manage them. You're making the biggest transaction that you will in your entire life. Like, a house is expensive, right? I know people who buy cars on a whim, a 5 minute decision. I want this car, I want that car. A house is not like that. It's much, 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 much more expensive. You can't just outsource it. And so I think if you're spending so much time, like basically 40, 50 hours a week to earn a salary of 60K, 100K, 150K, 200K, whatever it is, but you're letting someone else invest 500K, thousand, like $1 million with no input of time on yourself. Like, I know you're busy with no input of time at all, then it just doesn't add up. Like, it doesn't make sense. And to your point around interstate investing, actually, it doesn't take that much time. It honestly doesn't take that much time. A lot of people in Sydney and Melbourne, they only buy in Sydney and Melbourne because they're like, oh, at least I can inspect it. At least I can drive past it. At least I can have that emotional feeling that it's just there, right? But actually, property investing is all about the numbers. And I think accountants are, expert in numbers more so than almost any other profession. And so when you want to buy an interstate property, and let's face it, all properties in Sydney and Melbourne, anything half decent is probably at least 600, 700, if not $1 million plus. So there's a huge buy-in cost, which there isn't in a place like Brisbane or Perth or Adelaide or regional Australia. You can buy as little as 300K. So it's more accessible. And also in Sydney and Melbourne, basically every single property is going to cost you money on a yearly basis to hold because the yield or the rental income is not that great. Whereas in Brisbane, Adelaide, Perth, other regional parts of Australia, the rental income, the yield is much higher. So it makes a lot of sense to at least be open to explore other places. And so the natural, question becomes, well, but then it's really hard to buy interstate. I don't have time to catch flights every weekend. I don't know how to do that. And this is really something that I discovered when I bought my first property living in Sydney. I bought in East Gosford, which is towards Newcastle. I just found that if I could select the right suburb based on data and then select the right part of that or pocket of that suburb based on other both quantitative and qualitative data including like flood zones, flight paths, and seeing what the topography of the land was. You don't want to buy a sloped property, etc., etc. Then the next step, I could just call a local property manager and they would do the inspection for me. So they would go through that property and tell me if there was anything wrong with it, if the pictures on real estate or domain were fake or just like misleading, and whether that property actually had tenant appeal or future resaleability, future owner occupier appeal. And when I asked my property manager to do this, I was kind of half expecting them to charge me a lot of money because it's like, yeah, it's a decent amount of work. But they said, no, we don't charge money for this because if you do end up buying it, then we get to manage that property for the next 5, 10, 15, 20, 25 years. So it's in our best interest to find you something that's actually low maintenance, not going to cause us a hassle. It's going to be a really low, like set and forget, low headache type property. And when I kind of realized that property managers could do this, I was like, hang on a second. Now I don't need to just look in my backyard. I can use data objectively to point me to whatever the best suburbs are nationally. There's 15,000 suburbs in Australia. And I can just call local property manager in that area to do the inspections for me. And then, of course, anyone who's bought a property, you know that you also get a building and pest inspection done before you go unconditional on that contract. So a building and pest inspection means that a like more professional, certified builder comes through and sees if there's any cracks or anything like structurally wrong with the property, termites, etc. And with these two stage gates, or with these two, you could say, avenues of due diligence, then I can be comfortable that I've never seen that property. I'll probably never see that property, but it's going to be a really, really strong investment. There's nothing going to go wrong with it. And as I go through my tenure of holding that property, my property manager will continue to collect the rent. If the tenant leaves, they'll find a new tenant. If there's maintenance to be required, they'll get the quotes, they'll do all of that. And that really allows me to maximize my return on investment because it's very unlikely that the best growth suburbs are in your backyard. It's probably likely that they're not just in your backyard, they're elsewhere. And so that really helps you to scale a portfolio and just maximize your return on investment. I don't know if that answered your question, but that was
Yes. I already writing down. So I will start calling the property manager from
yes.
tomorrow, doing the inspection.
They're
That's a really
wonderful
good
people. They're
idea.
not agents, like they're not real estate agents. People don't
Yes,
realize they're not trying to sell you the property. They're
that's right.
different from
That's
real
right.
estate agents.
It's a different vision from that point.
That's
Um,
right.
yes. So when you talk about, okay, we're looking at the data. So can you share with us a little bit what's the data you normally looking at when you're looking for your own like investment properties?
Yeah, sure. Well, basically, like it's no secret, and I can kind of go into it a little bit as well. We look at 30 to 35 data metrics, and it's just like with anything, you economics 101, you learn that prices rise when demand is more than supply, right? And prices fall for any good or service when supply is more than demand. So we really want to try to understand what are all the demand side data factors to ascertain how strong demand is. And then let's compare that to all the supply side data factors to ascertain how weak or strong supply is. And we can then project this using thresholds per factor, trends per factor, and coefficients based on that statistical technique I was mentioning before per factor. So I made some notes here, like I'll just go through them. So one supply side factor that we look at is stock on market percentage. So stock on market percentages in that suburb, um, of all the properties that exist, how many are for sale? Okay, demand can be huge, but if 10% of all properties in a suburb are for sale, there's a pretty good chance that prices aren't going to rise because supply is so strong. Okay, and another factor is days on market. Now, this is on the demand side. So this is how many days does it take for a property to sell? Now, it's like a very obvious thing. I mean, most people would know this anecdotally, but if you can quantify this, then you can say, okay, well, supply is low, but demand seems to be low as well because it's taking 90 days or 3 months to sell a property. But if supply is low and demand is low, demand is high, like days on market is like 20 days, like less than a month to sell a property, then you know that there's something further to investigate. And then we look at things like previous rental growth. Has that rental demand been steadily increasing over the last years? We look at building approvals. So right now, demand might be bigger than supply, but in the future, is supply going to catch up, therefore eroding that sort of price growth potential? And we look at that building approvals, like has the council approved a lot of new buildings or a lot of new dwellings, residential dwellings in that suburb? And if they have, then there's certain thresholds we work to. Then that means that, oh, it might be a good investment now, but 2 or 3 years from now, prices might stabilize or they might go backwards. Um, we look at average vendor discounting, which is a demand side factor. So average vendor discounting means, on average, what percentage do sellers need to discount their homes in order to sell them? So if they list it at 500K, did they end up selling it for 450, in which case there's a $50,000 discount, okay, like 10%? Or was there a negative discount? They actually ended up selling it more than what they listed it at. Okay, so that's another demand side metric. There's things like job advertisements. So in that local government area, sure, right now it might be a booming economy, but how are job advertisements looking as a trend going forward? Because then we can ascertain, is the unemployment rate going to rise? It's a leading indicator basically of unemployment or employment, I should say. So like this, if you go through 30 to 35 data factors, and you don't have to do this like one-on-one, like one by one per suburb, that would be a massive headache. If accountants can run Excel spreadsheets, right? You just get like a big data dump and look at all 15,000 suburbs at once. It's almost like running a pivot or like a power pivot, if anyone knows what that is. Like, I think everyone would know. It's a kind of very simple thing. If you're kind of a little bit savvy in Excel, anyone can do a pivot table. And then you can very quickly see, okay, based on my thresholds, based on my coefficients that I want to target, which are determined by the multivariate regression analysis that I've already done, which suburbs are actually having an imbalance between demand and supply now, and which suburbs are likely to continue that imbalance. And it might be that there's 5 in Perth, there's 3 in Sydney, there's, I don't know, 10 in Brisbane. I'm just making this up. And then you can take that short list of 20, 30 suburbs, however many you want, and then say, okay, I only want to invest in areas that aren't going to cost me any money to hold, okay, from a cash flow perspective. And so I want to draw a line in the sand at, let's say, 6% yield or 6.5% yield, or when interest rates that were a bit lower, 5% yield. And so you can say, all right, of those 20, 30 suburbs, there are these 5 that I really want to target because they're going to grow in value and the property is going to pay for itself. Okay, and if the property pays for itself, much like the strategy I deployed when I was when I was a banker, then I can actually afford to buy more properties. I can actually afford to buy multiple properties. It's not like each one is costing me an arm and a leg to hold every year. So that's really the factors that we look at, or an example of the factors that we look at. And it's just a systematic process. But what I found is like almost no one was thinking about property this way. Most people were like, oh, I live in Sydney or I live in Melbourne. I should just buy as close to the CBD as possible. Oh, damn, I can only afford an apartment. I'll just buy an apartment in Docklands, or I'll just buy an apartment in St. Leonard's or Parramatta. And then 10 years later, that thing is valued the same as what they bought. And they're like, oh, property investing doesn't really work.
True, true. Totally agree with it. And also, when you mentioned about supply and demand, we found this quite interesting trend, like before COVID, I think back 2020, when that time the COVID just started, people got really panicked and not sure what's going on here. And then I think there was I think he's like in the one of the major banks say, oh, the property market, the value will be dropped like 20 or like 30%.
Mhm.
But surprisingly, during the COVID, these 2 or 3 years, the property market is actually really, really good. And well, obviously, because one of the like important points, because the interest rate is extremely low. I'm pretty sure this year will be really tough for some investors when the fixed rate got expired. It's like really painful because the interest rates are double up or 2 or 3 times double. So what's the trend you can tell at the currently property market looks like?
Sure. Yeah, so it's fantastic. Such a fantastic question. And it's kind of like this question that I always get, like, oh, hey, PK, is this a good time to buy property
Yes,
or
that's
not? Like,
right.
you know.
That's my question.
And like obviously the answer is like the best time to buy property was yesterday. But apart from being like cheeky, um, the truth is that there isn't one property market. Like I said before, there's 15,000 suburbs in Australia at any one time, whether it's 2000, 2005, 2010, 2015, 2020, during COVID, 2023, right here. There are some suburbs that are falling in value. There are some suburbs that are just going sideways. And then there are other suburbs that are going up in value. And so like last year is a really prime example of that, where Sydney and Melbourne fell by I'm just rounding, like roughly 10% last year. Both property markets on aggregate fell by about 10%. But then you had parts of Perth, like areas like Rockingham City Council in Perth, and Swan City Council, Joondalup City Council in Perth, that went up 10 to 20%. You had places like in Bundaberg in Queensland, regional Queensland, went up like 20, 25%. Places like Mount Gambier in regional South Australia go up 20%. Adelaide continued to go up. So what I'm trying to demonstrate is that this question, although well-meaning, like what's the property market doing? Is it a good time to buy? Like the more legible question is, where should I be buying if I want to be buying, right? If I have the financial capacity and risk appetite, of course, to be buying real estate, the question is always where to buy, not should I buy or is it the right time to buy? And just going around, like at least capital cities right now, you can see that Sydney is growing like really, really fast. It's actually growing at an annualized 12% growth rate, which is perplexing, right? Because it's like, hang on a second, all these people have just come off their fixed mortgages that maybe they got it at 1.9%, 2.5%. Now they're paying 6, maybe 7% variable rate. You know, the inflation is so high, cost of living is up, unemployment might be ticking up a little bit soon as well. Like all this points towards a property kind of downturn. But so why is Sydney increasing? And it's increasing because listings are low. Like people, the last thing people want to do is sell their property. Like they'll do anything and everything but sell their property. Okay, they'll cut down on their subscriptions, stop eating out, etc., etc. And when then listings go down, like I was sharing before around stock on market, and demand stays stable, even if demand doesn't go up, but supply just comes down, then prices go up. Okay, and so Sydney's going up. Perth is, in fact, right now as we speak in August 2023, every single capital city except Darwin, I think, is actually increasing in value. And who saw this coming? You know, when you think the mortgage cliff, interest rates going up so much, cost of living going up. How on earth are property prices increasing? There's so much more to property than just interest rates, right? There's population growth, immigration, there's the supply story, there's the fact that there's record low buildings right now because construction prices have gone through the roof. There's so much stimulus money that's still on the sidelines. There's so much, I could go on and on, right? So I think it's really important for anyone who wants to invest in property to just become at least a little bit educated, to see, okay, where should I invest? Hopefully that answers your question.
Yes. But first thing, maybe you can enroll like PK's courses. Get some like
Honestly,
ideas to start
I
before.
don't mind. I honestly
Yeah.
don't mind. I really want people just to be educated. I think the best
Yeah.
education to start with is actually free education, and
Yeah.
that's kind of the reason I have my Facebook group, as you know,
That's right.
Yuki, and
Really
there's
good group.
like
Yes.
there
Yes.
almost 40,000 people in there.
That's
My
right.
YouTube
Yeah.
channel, because I think like you shouldn't have to pay money just for basic education. And then once
Mm.
you've got basic education, financial literacy, property market education, based on data, like not my opinion, right? Just based on data,
Yeah.
then you can ascertain, oh, hey, is this right for me? Like I don't know what the statistics are, but there's correct me if I'm wrong, Yuki, but like the statistics are like I think it's like 70% of people who start a particular university degree don't finish that university degree. They end up changing,
Mm.
right? They go from commerce to arts or something else. And same with careers. If you start as an accountant, I don't know, I don't want to pick on accountants specifically, but if you start as a profession, I think the chances are more than 80% of people don't finish their career in that same profession. In fact, after 5 or 10 years, they pivot. And so it's because we don't actually learn what accounting's all about before we become an accountant. We don't learn what a university degree is all about until we actually are in the first year. So I believe in like just not having to learn the hard way. So I think if people can get free education, then they can be like, okay, property investing, look, I know I can leave my 9 to 5, but for me, like it's just too much of a risk. I can't sleep at night, like, calmly knowing that I have $2 million of debt across different properties. Or that might be exactly what you want. You might understand the concept of good debt, and you might be like, actually, using the bank's money is my ticket out of the 9 to 5. And I know that I'll have to make some sacrifices for 10 years, but after 10 years, I'll have this passive income and I don't have to worry about working. So, different courses for different horses, right?
Definitely, I agree. Especially I actually changed my career. So I love accountant, being an accountant, helping people doing all this stuff thing. But my passion is more helping people to understand how you're working with the bank to getting a loan done to build up your portfolio. So that's the whole. I can feel myself. I have passion on it. So I also go back to your point about the cash flow. Totally agree because before I always thinking, oh, the tax benefit, how I can make, pay less tax. But from when I actually start working in the banking industry, that's actually changing all my old concept. You have to making the profit before you can go to the bank to getting more loan.
Yes.
Let the bank to you trust you to you have the capability and the ability to repay the money they borrow to you. So that's really, really important. I think this is a little bit conflict between as accountant or working in the
Yeah.
bank. So
Yeah.
yeah. Okay, we actually got a couple questions in the chat. So do you mind we just jump into the
Yeah, let's go
question
for
first?
it. Yeah.
Okay. Another question for you is how do we get this raw data?
Sure. So the raw data itself, it actually costs a lot of money. So what you have to do is you have to go to like a research company or research house like Price Finder or CoreLogic RP Data, and you have to ask them for basically like last 10, 20, 30 years of raw property data, and they'll give you like a CSV dump, and then you obviously need to know what each column is defined as, and you need to figure out, you have to cleanse it for all of the peculiarities, and and unreliability of data, etc. So that's where you get it. It does cost a bit of money, like $10,000 or $20,000. But the great thing in 2023, which I didn't have when I started, is there's a lot of websites out there that actually give you really strong raw data that's somewhat processed for a much more affordable price. So, for example, even like the ABS, like Australian Bureau of Statistics, they give fantastic data that you can then interpret yourself, like websites like DSR data. They give you like fantastic 3-year trends of different data points, like some of the ones that I mentioned before. Unfortunately, there's not like one magic website that just gives you all these 30, 35 factors. So what I teach is actually where to go to get what data and then how to bring it together and interpret it, because like data is powerful, no doubt. Data is really, really powerful. But if someone just gives you an Excel file with like 20 tabs and each tab has like 100,000 rows, then it's like power is in my hands, but I don't know what to do with it. Like, what does this mean? So I think the true value add is in the interpretation of that. And I think a lot of companies out there and a lot of different content out there just tells you what to do. But who's to say they have misinterpreted the data, or their coefficients are wrong, or the thresholds that they're looking at are incorrect? For example, like a very big myth out there is that population growth actually precedes or is a precursor to capital growth. And that's actually incorrect. I mean, intuitively, it sounds logical, right? Like if more people come into a suburb, then like surely like the prices would grow because demand would grow. But if you think about it, let's say for the anyone in let's say Sydney, right? If you think of a well-established suburb, let's say Epping, okay, Epping or Hornsby or whatever is a well-established suburb. How can more people come into that suburb? Because there's no spare land. Like they're all just residential houses everywhere. So in Epping has gone up a lot in the last 5, 10, 15, 20 years, but population hasn't increased. So there must be something else that's causing capital growth, because there's the same amount of people that live in Epping today that there were 20 years ago, right? And in fact, those suburbs with the most population growth actually have the biggest supply growth as well. So I'll use an example like in Brisbane, like in Caboolture or Morayfield, huge increase in population, but that population was facilitated by like thousands of new houses or hundreds of new houses. And so supply went up, more houses, demand went up, more population, and they canceled each other out. So a lot of these kind of most people, with all due respect and humility, most people don't actually understand true property economics. And that's why I'm saying that data is really important, but the interpretation of it is actually like really the key to getting somewhere, if you know what I mean.
Thank you. And we have a Teresa here saying, how much time do you need to invest in study analysis those data? Especially you have like a full-time job, like you're exhausting after work and then
Yeah.
sitting in front of a computer looking at those data. It's like,
Yeah, no, I think it's like a fair enough question. And I think the first thing that I'll say is like analyzing property markets and buying a property is not like watching Netflix. It's not like a passive activity. It's not like, like you can just relax and do it, so to speak. You don't actually need that much time. So what I say to people is, if you're actually educated or you're being educated and you want to buy a property in like a systematic education, sort of structured way, then 3 to 5 hours a week over 1 or 2 months, sorry. So that's 4 to 8 weeks, 3 to 5 hours a week over 1 or 2 months, you can buy a property. That includes the education and the implementation. That includes not only the data analysis, but also strategy development. That includes then finding properties, building your team of property managers, building and pest, conveyancers, accountants, etc. That includes getting those properties inspected, getting them valued, negotiating, settling on those properties, getting like the whole, kind of life cycle of like not knowing anything to getting it your first tenant in your first property. That's 3 to 5 hours a week over 1 or 2 months. And like I think that's kind of a welcome, maybe a refreshing kind of thing for people to hear, because they automatically think this is like a full-time job or at least a part-time job, right? But it really isn't, if you're doing things in a structured and systematic way.
Thank you. I thought you want to talk about like 3 or 5 hours each day. I was like,
No,
I
no.
give up.
I'd
No
be
way I
out
can
of a
do that.
job if that
Yeah.
if that was okay. I mean, I
Yeah.
must say these are like focused. This is not
Yeah.
like
That's true.
two kids in each hand and like,
Yeah.
distracted.
That's true. And also I agree. You have to find sometimes you have to build up your own team. Like you have good accountants, really, responsible conveyancer or solicitor.
Yeah.
So it will be make your life much easier. So
Yeah, yeah. And like I provide the team to my clients, but I'm always, like I say, I'm a fan of being educated. So just because I've given you an accountant or a conveyancer or this
yeah,
person or that person, it doesn't mean that you should trust me blindly or that you should trust them blindly. You should
that's
actually
right.
know how to manage them. Like you're a
Mm.
captain, if you're a captain of like a soccer team, you actually know the strategy, you know the individual strengths and weaknesses of each of your team members better than they know it themselves, and that accordingly you can manage them. And I
Yeah,
think that's really important given that you're spending $1 million, $500,000, and getting all this debt.
yeah, true. Okay, we have a here. Eric asked a question. So, what's a good strategy to buy at lower the valuation amount? Oh, that's a good question. And how to search property like this?
Oh, that's a fantastic question, Eric. Thank you for asking it. So there's many, many ways. Um, I think let's go through a couple of ways of many. Excuse me. One way is to understand the value add potential of that property better than the seller or agent. So, for example, I just posted this in the Facebook group the other day. One of our members, he understood by calling council, because he was educated, that this particular property was on, I'm just making this up because I can't remember, like let's say 1,000 square meter block. He understood that it could be subdivided into 3 lots, because he had got a hunch because he was educated, and he confirmed that by calling the town planner at the council, and they confirmed it. Whereas the seller and the agent, the selling agent, they thought you could only subdivide it into 2 lots. Now, I know this is a bit of a technical term in terms of subdivision, but just to make the point, the more you can subdivide it, the more houses or townhouses you can build on it, therefore the higher end resale value, right? And so he kind of kept those cards close to his chest, and he paid whatever the seller wanted. So the seller was completely happy. It was like, oh, great, I got what I wanted. But actually, the property was worth way more because it had this far more higher and best use that the agent and seller didn't know about. So, one way is actually just to know that the zoning and the rules and the property way better than even those that are selling it. And with no disrespect and with all love and kindness, the property market is a very inefficient market. It's not like the stock market. It's very hard to get a good deal in the stock market because everyone who's selling is an investor, basically, and everyone who's buying is an investor. But in the real estate market, 70% of people who are selling are actually owner occupiers. They're not investors, which means that they, mostly speaking, don't really know true value of the property. Like it's an emotional decision for them whether to buy it or sell it. And if you're the investor and you have that much more education and that much more know-how, you can actually ascertain like so much more about the property than the seller. And agents, they're not like CPAs. They don't have to do like a 2 or 3 year course and like 120 hours every 1 or 2 years to maintain their qualifications. To become a real estate agent, and with all due respect, it literally takes like less than a couple of months, right? It's not that much of a rigorous process as you might think. So a lot of these people, there's some fantastic agents out there as well, don't get me wrong, but in my own experience, like the vast majority of them, once again, they're not property investors. They don't know as much as you may give them credit for. And so if you can really become educated, then you can, I don't want to use the word exploit, but you can make the most of this inefficient marketplace. And the second way to get under market value properties is to get them off market. So what that means is even before they're listed on realestate.com or domain, this is so simple. Anyone can do this. You just call a local real estate agent. So this is a website called ratemyagent.com.au, and it shows for every suburb across Australia, like the top rated real estate agents. So let's say you want to buy, like I live in Sorrento on the Gold Coast. Let's say you want to buy in Sorrento. You can look up that suburb Sorrento and you can find the top 3 agents. And then on a weekly basis, like let's say on a Monday morning for 5 minutes, you can call each of those agents. You can be like, hello, Mr. or Miss Agent. My name's PK. I have my finance ready. I've got my pre-approval. I'm a committed buyer. And this is kind of like my criteria. I'm like really looking forward to buying a house in Sorrento. If there's anything that kind of comes up in this kind of price range with these characteristics, let me know because I can make your life easy. You don't want to run multiple campaigns, multiple inspections, have so many time wasters and tire kickers. I'm ready and professional. I'm ready to go. I can take this off you. And you might need to do that for 1 or 2 or 3 weeks. And then all of a sudden that real estate agent's like, oh, I remember PK. He keeps calling me, like, asks me how my weekend was. He seems like a nice guy. Actually, I do have this property coming for sale, and I do know that my client, the seller, they just want a quick sale because they're a little bit private, or maybe it's a deceased estate, or maybe, they've just bought a new house and they really need to sell real quick. I'm gonna give PK a call because I think I can get this deal done real quick and not have to spend money on marketing on realestate.com, etc. And that way, you've just built this amazing relationship, got this property with no competition. And when there's no competition, that means you can negotiate on it so much better and get that thing under market value. So there's so many ways, but I'm really passionate about that, as you can see. But it's you don't have to pay the market value for a property.
Oh my God, this is my second important point to take home. Um, yes. So we have also Lily here say, do you think apartments are still worth to invest in?
Okay. Um, so once again, like it's a great question, Lily, and like I was saying before, there are apartments in Sydney, there are apartments in Melbourne, there are apartments in Brisbane. There's like all sorts of different types of apartments all over Australia. So it's hard for me to be like generic in the answer, but I'll try to be generic as much as possible using this concept of land to asset ratio. Now, the old adage in real estate is that land appreciates because they don't make more land. It is what it is. Land appreciates and buildings they depreciate, as every accountant knows. They prime cost method or diminishing cost method. You know, buildings or assets they depreciate. So what really drives capital growth over the long term is a high land to asset ratio. You want the land component of the real estate asset that you buy to be more than the building component or the dwelling or the bricks and mortar, like at least 60%, I would say. And so apartments, you don't really have that land component. And like I remember there were like these stories of like back in year 2000 when they had the Sydney Olympic Games in like World Square and like the center of Sydney. They built that, well, they built that building, World Square, and they were selling those apartments, and there was like shiny brochures, and it was amazing, like in the city center.
Yeah,
How could you go
I
wrong?
remember that. Yeah.
Yeah, there you go. And they were selling them for like $500,000. And all these people, especially foreign investors, they climbed in. They were like, what a bargain in the middle of Sydney. And like fast forward 10, 20 years, and those things are like basically still worth like 500,000 or 600,000, 700,000. The reason is that in that same time in Sydney, there's like, I'm exaggerating, there's like a million more apartments that have been built, right? Or at least in the city center, there's literally thousands, if not tens of thousands. So there's no scarcity of supply in apartments because you can build up to the clouds as long as the zoning allows. For anyone who's been to Hong Kong or New York or etc., like how high you can build. So we want to buy something that's scarce and that will become more and more scarce, and that's the value of land. So in general, my answer to this question is always avoid buying apartments. And a lot of people err towards apartments because they're like, oh man, I can't afford houses because it's just too expensive. And this is where that concept that I was talking about before comes in, being an interstate investor. Like, sure, it's hard to be an investor in Sydney when everything's like $1 million plus. But hey, Brisbane's got opportunities under 600K. Perth has got opportunities under 600K. Adelaide's got opportunities under 500K. Regional, like place like Toowoomba, not that I'm kind of promoting any particular place. I don't really mind where you buy, but Toowoomba is like as diversified an economy as Brisbane, but you can buy something for 400K. And so I think when people realize this, they have that sort of aha moment and like, why should I buy something so expensive that's going to cost me so much money to hold in Sydney? Or why should I buy like a really underperforming asset like an apartment in Sydney? Why not buy like a scarce landed house in Toowoomba or in Brisbane or somewhere like that? So sorry, that was a long-winded way of answering your question, but I generally speaking avoid apartments.
So I hope Lily you got your answer. Start looking for house from tomorrow.
Yeah.
Right. So you mentioned about like Queensland. So the next question from Rebecca say, do you think Queensland still worth to invest right now?
Yeah, I do. And once again, there's markets within markets. So some areas to potentially avoid in Queensland are like almost like where there's not diversified economies. Like you could say Emerald is a mining town. Like there's no doubt about it. Coal prices come down, which they are, then Emerald property prices come down because all the workers they flee from Emerald, they go back to Brisbane or wherever they normally work. But there are other much more diversified regional areas in Queensland, like Townsville, like Bundaberg, like Toowoomba that I just mentioned before, that have, you might not have heard of them because we may be very Sydney centric or Melbourne centric. But if you take the time to educate yourself, like Townsville was definitely a mining town 10 years ago. In fact, the unemployment rate was almost 10% back then. But in the last 10 years, it's diversified so much that actually in the top two or three industries now in Townsville is not mining, it's like healthcare and education. Same in Bundaberg, that healthcare, there's more per capita infrastructure spend in Bundaberg than there is in Sydney. And like that is phenomenal when you think about it, right? Because you always think all the infrastructure goes in Sydney. But on a relative basis, and relativity is really the most important thing in property markets, like you drop a stone into a lake and it doesn't really make a big difference. You drop the same stone into a bathtub and it makes a much more ripple effect. And so, you might have amazing infrastructure going in Sydney, but if you have even less infrastructure going on in a place like Bundaberg, but because Bundaberg's small, it has a bigger impact relatively on property prices, on per capita wealth, then that is what drives real estate markets. And so that's another area that I think is really worthwhile investing in. And of course, Brisbane as well. Brisbane has had a huge run up, more than 50% growth in the last couple of years, but it's got a long way to go still. And there's really a lot of those areas that had a lot of developable land supply, a lot of new houses coming in, like parts of Logan City Council, up near Moreton Bay City Council. All those houses are built now. And with construction prices the way they are, and it's like impossible to find a builder almost anywhere, and all these building companies are going bust, as you guys know. New developments are really scarce and demand continues to go up, so prices continue to go up. So yeah, I think there's lots of places in Queensland. In fact, Queensland and Perth are probably not according to my opinion, but according to the data, some of the best areas to invest in across Australia right now.
Cool. So the next question actually from Caroline. Do you mind just unmute yourself? Give us like a rough. I'm really apologize because I didn't get the question here.
Sure.
Thank
Yeah,
you.
so my question is like between the two options, which one would PK recommend? The first one is the suburb currently experiencing demand surpassing supply, but also with potential for continued undersupply in the future. And the second option is a suburb where currently supply exceeds demand, but there is a potential for future demand overweighting supply. Because in the case of undersupply, that means the price to purchase the property is likely to be overpriced, if that makes sense.
I understand. I think I understand your question. So basically, what you're saying is it better to buy in like a hot market now where demand exceeds supply and is likely to continue to do so, or is it better to buy in quote unquote more undervalued area where it's not so hot, but may become hot in the future? Is that right?
Yes, exactly.
Okay. So like obviously the panacea or what everyone wants is to buy in like this perfect location where like no one else knows about it. And if I just buy today, then all of a sudden, like, you know, in a month's time or 6 months time or a year's time, you know, everyone will jump in. It's like, yeah, not to be like facetious or anything, but I remember like, you know, back at work times, people would want to know that stock to invest in and be like, okay, what's like that stock that I should buy, that share that I should buy, and then everyone's going to jump in and I'm going to make so much money. But I think the reality is that if you know about that stock, like let's say it's BHP or whatever, then there's probably so many other people that already know about that stock, unless you have insider information, which is illegal, and therefore the market has already priced in whatever the good thing is about that stock. Do you know what I mean? So real estate markets sort of work in a similar way. Let's use Sydney as an example. So last year, like let's say we are having this conversation last year, August 2022, and you were saying, okay, PK, Sydney has more supply than demand right now, therefore prices are going down, generally speaking. Is it better to buy in Sydney right now, or is it better to buy in, let's say, Perth, where demand is more than supply and it's likely to remain more than supply? So my answer back then, with benefit of hindsight, of course, but my answer back then and even now is it's always better to buy in Perth. And the reason is that if we can know that prices are going to increase now and they're going to increase in the future, then even though we might not be able to get like a terrific deal, like an absolute terrific deal, $100,000 under market value or whatever the case may be, we know that that thing is going to go up in value. Okay, so we're paying fair market value. Assume we don't have that conversation around off-market deals and building relationships with agents, which can happen in hot markets too. Assume you don't know all that, then you're just paying fair market value and you're just getting that amazing upside over the next 1, 2, 3, 4, 5 years. Okay, in Sydney last year, it's like trying to catch a falling knife. Sure, some vendors might be desperate. You might be able to bag a bargain. Let's say you bought something $100,000 under its true valuation, but it's like catching a falling knife. How do you know that even though you've bought 100 grand under true valuation, that property is just not going to continue falling, you know, another 100 grand, and therefore your bargain has been evaporated, and then that the price growth may or may not occur. So I kind of liken property markets to like the Titanic sometimes, where or like large ships, not in the sense that they like sink and go down and you lose all your money, but in the sense that they're very hard to maneuver. They're very hard to change the trajectory of. Okay, so like when the guy or gal saw the iceberg in front of the Titanic, it was probably, I don't know, like 100 meters away, 200 meters away, but they still ran into the Titanic. It was very hard for them to change course. And property markets are the same. You know, when prices are rising, they tend to rise for like, you know, multiple years. The average up cycle goes for 2 to 4 years in real estate markets. And so that's going to continue happen. And same on the downside as well. Unlike stock markets where, you know, you might buy a bargain today and then tomorrow that thing goes up 10% and the next day it comes down. So I like to buy safe and secure assets where I know they're going to increase now and in the future, and less try to gamble or speculate that it may or may not go up in the future, but I'm getting a great bargain now. Hopefully that makes sense. Of course, the caveat to that is like if you're just getting like this unmissable, amazing deal where you're getting like 30% off for whatever reason it might be, like that would be hard to give up. But yeah, generally speaking is what I'm saying.
Yeah, so my understanding is like the historical data, if the historical data shows the increasing trend in the property price in the suburb, which also demonstrate greater potential for future growth.
It's
Can I
more
understand it that way?
it's more like what it's doing. It's less about like historical price movement, more about current price movement, but even more importantly, current like data factors, like those demand factors that I talked about, the current supply factors. And the reason I say that is because actually, once again, completely counterintuitively, past performance in real estate markets is, you know how in like disclaimers they say past performance is not an indicator of future performance. That's actually really true in real estate markets, where those markets that have performed really well in the last 10 years tend to underperform in the next 10 years. And that's just because of regression to the mean over the long term. All property markets actually perform exactly the same. So I digress a bit, but over a 30-year period, even a place like Launceston, like a small little place in Tasmania, has performed just as well as Sydney. So it's all about timing the right markets. And to give you an example, between 2004 to about 2013, Sydney was like dead flat, didn't do anything. And then the next 10 years, as we all know, 2014 or 13 to about, now, Sydney has like gone up more than double, if not almost triple. And so the likelihood is that the next 10 years will underperform. So we have to try to find, okay, which property markets around Australia were really bad in the last 10 years and have really good data right now to suggest the next 10 years will be really solid. That's kind of more of a zooming out way to approach it. But to answer your question more clinically, it's just about looking at current price movement and current data as opposed to the last 2 years or whatever.
Okay, thanks, PK.
Yeah, thank you.
Thank you. So I think the next question is more about yourself. So we got a question here. So might I know your view of how to arrange your investment portfolio? Like for example, buying a house and rental, or you buying a land and building your dream house by yourself. So which one you think is quicker to make positive?
Yeah, sure. Sure. This is a really good question, by the way. So I've done both. So I started off, excuse me, just with the standard buying established property. And, it's easy. It's already there. From day one at settlement, you can rent it out. Very passive strategy. So if you have like a really intense job, or you're not really that passionate about real estate, that's like your strategy, right? Just buy a house, established house, rent it out. If you have a little bit more time or a little bit more passion, or you should say drive, then we talk about development. So development is where you find a piece of land, and you build on that yourself. Now, of course, that is different to you buying a house and land package. A house and land package, or what we call turnkey packages, you guys might have heard of, is like where there's like some fancy company that is saying, oh, here's this land, we'll do everything, we'll build it for you, we'll do everything, and you have to buy it. That is a really terrible idea, because they tend to put in their own margin or their own profit as part of the deal. So you're most cases overpaying for the property, and they tend to be in like far out locations, like fringe areas of the city, where most of the time the demand supply metrics aren't well balanced, to be honest. But the really quick fire way to financial freedom, for want of a better way to explain it, is to buy land yourself in like infill areas. So not like really far out in the middle of nowhere, but like in established areas. So for example, I know when like our first place was in a place called Banyo, in Brisbane, and it was 10 k's from the CBD, and there was like this pocket of land that was formerly owned by the army, and that kind of released it and to like just private investors, and you could buy a piece of land, and then you'd have to source your own builder to like build on it. But all around it was already established suburbs. Like there wasn't like just acres of farmland or whatever. And so if you can find something like that and then engage your own builder, and of course you need the skills to do that, and build on there, then what generally happens is that the end value of the house is more than the sum of the parts. So the land plus the building cost or the other transaction costs end up being less than the final resale ability or resale value of that property. So that's a really good way to make money. And of course, if you take it to the next level, then you're actually, let's say buying an established property, and you're knocking that property off, and you're subdividing that land and building multiple townhouses. Like we did a deal in Coorparoo in Brisbane, which is a fairly affluent area at the time, I would say. It was like a corner block, and there was this old Queensland house at the front, and there was a granny flat at the back. And so we bought that property, renovated the Queenslander at the front, lifted that granny flat up, sold it for like $50,000, subdivided the back and built 2 townhouses at the back. And the profit in that deal was like, I mean, not that it's easy and it's just like anyone can do it, but the profit on that was about 300K. I mean, it required a lot of hard work, don't get me wrong. So there's like this spectrum of like completely passive, low risk, low time commitment, buy established properties, and like just work your way slowly out of your 9 to 5. And let's be honest, like that's not an overnight thing. It took me just over 10 years, I think, realistically for most people. Like I was on very grateful to say high incomes, and my wife was a chartered accountant, so she was making good coin as well. Just on average incomes, that will take you more than 10 years, like 10 to 20 years, let's say. But if you want to fast track that, then there's your more active strategy, requires more risk, requires more time, requires more skills of development. Like I mentioned, if you do a few of those developments, like the Coorparoo one, then you might be able to exit your 9 to 5 in less than 10 years. So that's the kind of way to think about it.
Okay. The next question, we got 2 more. So next question from Carlos saying, how about Tasmania? I think PK was mentioned lesson. Yeah, he said like before you didn't mention any Tasmania.
Oh, okay. Yeah, I don't know. No offense to any Tasmanians. I always just forget to mention Tasmania. Honestly speaking, it's been such an amazing, amazing, amazing market. I actually have a property, actually 2 properties in Tasmania, one in Burnie, and another just in Kingston, just a little bit out from Hobart. And just like any other location, I mean, we shouldn't, in the true if we're being truly objective and emotionless, then we should just buy a property based on the merit of the data in the suburb. And that's exactly what places like Burnie and Hobart were showing back in 2014, 15, 16, 17. They were showing a lot of strength in the data, and I bought there. A lot of other people that I helped bought there. And you'd think like, oh, Tasmania, is that even part of Australia? Like, such a small place, so cold, like why buy there? But once again, like Burnie, believe it or not, Burnie, where I bought, it's like a logging town, like a lot of forestry happens, there's a port there. The population of Burnie is actually reduced in the last 7, 8, 9 years. But my property has gone, that was a real cheap property. It went from 230,000, I think it's like just over $500,000 now. Okay, so like more than actually it's probably about 600K now or something. So like more than double in value in way less than 10 years. And the rents have gone up so much as well. And so it's like, why is that increase? It's because the incomes of that area have gone up a lot, alongside so many other data points. So if you kind of just followed like these old school like kind of doctrines of like follow the population growth, then you miss out on areas like that. And so yeah, Hobart has actually been a huge hunting ground for us as well. Not so much in the last couple of years. Now the affordability is really not there for locals. You never want to buy in a location where the locals can't afford it. Every time a property market or location or suburb is growing in value because of investors, that is a sign of a potential bubble. It could pop. But every time a location or suburb is growing because of owner occupiers, the locals buying to live or upgrading or their first home purchase, that is a sign of a boom, a sustainable boom. And that's exactly what we've experienced in this last boom, like in 2011, 20, 21, 22. Everyone's like, oh, when's this bubble going to burst? It wasn't a bubble because investors were mostly absent in the last few years, believe it or not.
True. So when you mentioned about emotion bias, I think the next question came in is, what are the key differences when the key difference concern between investment property and residential properties?
Could you clarify this question for me? Because obviously you can invest in residential property.
But I'm just thinking like, is there any different way thinking about, buying a property I gonna live in the future, maybe in next 5 to 10 years, or I'll just buy a pure investment property, maybe in other state, or I don't even, like take a look, or I can just, hand to the agent completely. I mean, is there any, when you consider those questions, is there any key concern or criteria you want to recommend us?
Okay. So if I understand your question, so when like there's sort of two schools of thought or two trains of thought. The first train of thought is like, let's say I want to buy to live, which I think is what you're suggesting. You can be like completely it can be an emotional decision, which is completely fine because you want to live there, right? Like even if it's not the best suburb in terms of growth, it's like that's where your friends live or colleagues live or community lives. It's close to, where you want to be lifestyle wise. The property itself, you might want a particular type of property that doesn't meet any investment guidelines, but you just love that type of property, and that's completely fine. So that's one school of thought. The other school of thought is obviously what we've been talking about, which is like, forget about living it, forget about emotions, just like what actually makes sense from a pure quantitative, data-driven return on investment perspective. And I think what I try to help people think about at least and explore is, even if you're buying to live, the statistics show that I think every 6 years or every 5 years, people move houses. And generally, when they move houses, a lot of people become accidental property investors insofar as they don't sell the first house, they keep it as a property, like an investment property, and then they upgrade or buy another house. So they've got two houses. So what I really encourage people to think about is, can you treat your first home purchase to live in with an investment mindset as well? Okay, as well. So there's like a circle here of everything that makes sense from an investment perspective in terms of suburb location, in terms of the type of property. And then there's a circle here that is like what you just fall in love with, the suburb or the property, or just like what your family loves, or just where you want to live, right? So try to see if there's a intersect between those circles, if there's a suburb that actually makes sense from a data perspective and you like to live in, if there's a property type that you love but actually makes sense from a property investing perspective as well. For example, like brand new properties generally make inferior or subpar investments over the long term because of land to asset ratio, what I shared before. Established properties, generally speaking, grow more than brand new properties, but some people love to live in a brand new property, right? And same with us, like we would love to live in a brand new property. So what we did is we bought this property that I'm speaking from right now, and we renovated it. Okay, so basically it looks like a brand new property. It was a bit of a headache, but it looks like a brand new property, but we mostly paid for the land, not the building. So that's just one kind of small example, but try to find the confluence of those two circles, and so that you enjoy where you live, but you can also make it an investment property in the future. Okay, because buying and selling costs in real estate in Australia are really high: agent fees, lawyer fees, etc., etc. You want to try and not sell anything that you've bought. So if you buy well, even if it's for the purpose to live in, then that's that kind of good investment mentality. And this wasn't, I don't know if I'm answering your question, and feel free to say that I'm not, but the other way to think about it as well is rent vesting. I don't know if that's a term that a lot of people here know about or have heard about, but rent vesting means where you're like, okay, well, I can't afford where I really want to live in Sydney or Melbourne or whatever. I'll rent in the lifestyle location that I want to, because I can afford the rent, right? I can't afford that 2 million, 3 million property, but I can afford rent in Manly, or I can afford rent close to the city or whatever. And I'll use my savings to buy investment property after investment property after investment property in cheaper areas, like you mentioned before, like Molly, like Interstate. Okay. And what a lot of my clients do, and it's not like some secret strategy, a lot of people just have been doing this forever in Australia, is that these other locations, while you're renting in Sydney or Melbourne, you've invested in Brisbane, regional, Queensland, Perth, Adelaide, whatever, these things, these assets are growing in value. And then in the future, you can either take equity out or you can sell a couple of them. And then all of a sudden, you've got this deposit for your dream home in Sydney or your dream home in Melbourne in the location that you otherwise couldn't afford. And you would never be able to afford if you just relied on saving from your job or from your business. So it's using, I guess, a bit of dexterity, a bit of leverage, using the bank's money to hold multiple assets. And over a course of, I don't know, 4, 5, 6, 7, 8, 9, 10 years, being able to get into a position where you can buy your dream home. So that's just, I don't know if this was your question, so apologies if it wasn't, but that's just another way to think about it.
Thank you. I think we will stop. We're taking the last question, and then considering time, I was like, oh, already 1.5 hours. So Xin got question here is about Melbourne market. So is it already too unaffordable? Is there any suburb you would recommend?
So the easy answer is I actually just did like a whole YouTube video on Melbourne like a couple of weeks ago. It's like, you should check it out. But I'm just trying to remember the main points from that video now. Look, honestly speaking, Melbourne hasn't really performed as much as Sydney or Brisbane in the last few years because the lockdown was much more severe in Melbourne, and the economy in terms of unemployment and small business health is much more shakier than other parts of Australia. And that's why the property market hadn't performed so well. So you can think about that as an opportunity. It hasn't done so well, so there's more opportunity for it to do well in the future. And that's definitely true. I definitely don't want to take that away from Melbourne. However, once again, much like Sydney, the yields in Melbourne are so low, by and large, that any property, basically, unless you're developing, any property is going to cost you money to hold. So if I just think about it objectively, without any bias, I don't mind if you buy in Melbourne or not, I'm just thinking, like, if I can get the same or better growth in another location around Australia than I can in Melbourne, but at the same time, that property in the other location is not going to cost me money to hold on a yearly basis. In fact, it might give me some passive income. Then why buy in Melbourne, right? Like, that's just like the truly objective way to think about it. And then you couple that with the fact that new state laws are about to come out from the state premier in Victoria around rental caps, around rent freezing, and really the pendulum is swaying. Not that it was ever for in the favor of investors, but it was really well and truly on the side of tenants. Your costs are now going up in a big way as a property investor in Melbourne. All of a sudden, I think, don't quote me on this, but last year or early this year, land tax increased in Melbourne. So now all of a sudden, investors, regardless of what they own, are pinged with another, I think it's $1,200 a year in land tax if you're a property investor. So all these things are really making it unattractive to invest in Victoria. And so, kind of putting all these points together and many others that I can't remember right now because it's pretty late in the evening, kind of suggests for me that there are much, much better places to invest than in Melbourne. Only exception is like if you're a high net worth individual, right? Everything that I've said goes out the drain. If you've got $5-10 million cash to play with, you don't care about cash flow, you don't care about yields, then you could go ahead and buy in Melbourne. The growth is still not likely to outperform any other location, but at least you can say I've got a property in Melbourne.
I'm totally agree. Cash flow is the king. I mean, also, sometimes when I speak to my clients is, especially when you purchase your first or second properties, buy something you can afford. You can buy and hold rather than you buying one, you pay a lot, like as a residential property. I'm not saying this is just a different trade of people thought it's different. This is my dream house. But sometimes from the bank perspective, residential property, that is the liabilities, not the income, definitely for sure. So just be, realistic a little bit, not like rely on the emotion part.
Yeah. I like to say I didn't coin this phrase. I don't know who did, but I'm going to steal it anyway. It's like cash flow is the engine, and capital growth is the engine, and cash flow is the oil.
That's
You
right.
need both, like without the engine, you can't actually create wealth. You can't take the car forward, but you can have the best engine, but without cash flow, you might have to sell that property if you lose your job or your household budget stinks. You need that oil to circulate through the engine to be able to hold that property. So both are equally important. And I think that you don't need to, not that I think, like history and data has shown you don't need to make trade-offs. So don't just go for growth, don't just go for cash flow, get both in every single property.
Most important, do some homework before you
Yes.
go to that market.
Don't be lazy.
Yes, that's right. Thank you so much, PK, to join us, and really appreciate for time and all those knowledge and information you shared with us tonight.
Thank you so much. No, I really appreciate it. I feel out of my depth speaking to a lot of CPAs here, but hopefully I
You
added
must
some
be so
value.
proud of yourself, So yes, for many of you, if you are interested in find out more about PK, first thing, check out his Facebook page, and then
Yeah, join the Facebook group, like Australian
yeah.
Property Mastery with PK. Like, honestly speaking, I think I can make stuff up. I'm fallible. I can be wrong, but the power of community. There's almost 40,000 people, and there are people much more successful than myself as well. So I think that group will serve to educate and inspire everyone.
Definitely. Right. Thank you so much for your time.
Okay, thank you so much. Thanks, Yuki. Thanks, Anthea. Appreciate it, guys.
Thank you, guys. Have a good night and enjoy tomorrow, the last day of the work. So happy Friday then.